everybody is buzzing about the S&P 500 hitting new all-time highs, totally fueled by this massive artificial intelligence boom. It's exciting, right? But right next to that incredible, skyrocketing growth is an invisible, ticking debt bomb sitting in the background of our banking system. It's wild. While you're watching your portfolio grow and seeing all these green upward arrows, extreme banking stress is quietly building up behind the scenes. We really have to figure out how to reconcile these two completely opposing realities.
Okay, let's dive into this. Starting top down with the broad economic picture, Goldman Sachs is actually projecting a surprisingly sturdy 2.8% global GDP growth for 2026. That easily beats the consensus forecast. In the US specifically, they're expecting 2.6% growth, and they're saying that's driven by a reduction in tariff drag, upcoming tax cuts, and just generally easier financial conditions. So underneath it all, the macroeconomic engine is definitely still humming.
And a massive chunk of that engine? It's AI for sure. JP Morgan is tracking the data, and they found that the top 5 hyperscalers are spending $730 billion on AI capital expenditures just this year alone. To put that into perspective, that is nearly an 80% jump from last year. Imagine millions of silicon wafers transforming into massive, sprawling server farms all across the globe. This level of sheer infrastructure spending provides a massive baseline of support for the whole economy. All that cash being deployed is directly translating into real corporate resilience. Commonwealth Financial Network noted that in the first quarter, the S&P 500 posted earnings growth of over 27%. Now, analysts had only estimated 14% at the start of the quarter, so companies are absolutely blowing expectations out of the water. Beneath all the noise and uncertainty, the foundational economics of the market are still roaring. Section 1. Global Growth versus Hidden Risks.
Now, even with all that undeniably bullish data, we really can't afford to just put on rose-colored glasses. We have to shift our focus to the macroeconomic headwinds, the hidden risks that are actively keeping institutional investors awake at night. This quote from Morgan Stanley perfectly captures the mindset we need today. Be constructive, not complacent. Energy prices and global tensions are creating very real uncertainty, and we have to acknowledge that these strong market fundamentals are currently sitting right on top of a very dangerous, fragile geopolitical reality brewing beneath the surface. So JP Morgan is basing their 1.5 to 2.0% US GDP growth outlook for the rest of the year on 3 key drivers. We've already talked about AI CapEx, but the second one is consumer spending, which remains highly resilient. This is being buoyed by stimulus benefits from the One Big Beautiful Bill Act, or OBBA, right alongside higher tax refunds. It's keeping households afloat even with unemployment holding at 4.3%. And their third driver? That relies heavily on a resolution in the Middle East. That geopolitical risk feeds directly into our inflation picture. The supply shock we've seen has been severe. The closure of the Strait of Hormuz for over 15 weeks created a massive bottleneck for oil, gas, fertilizer, and helium. Now, there is a recent 14-point memorandum of understanding between the U.S. and Iran that offers a potential bridge to normalize commercial passage, which is notable. But the reality is, this severe supply chain bottleneck has already made its mark on the global economy. Because of that specific commodity shock, JP Morgan actually had to bump up its year-end core PCE inflation outlook to 3.4% from their previous 2.9% estimate. Inflation is just proving to be a lot stickier than anyone anticipated at the start of the year. Now, what's really interesting about this is how this sticky inflation forces the Federal Reserve's hand. Based on JP Morgan's projections, the Fed is likely going to hold the Fed funds target range steady at 350 to 375% for the rest of 2026. This creates a ripple effect. Well, more like a wave, really. 10-year treasuries hover around 4.7%, and importantly, this basically locks the housing market into a new normal, where mortgage rates stay above 6%. And honestly, the turbulence doesn't stop with interest rates. Commonwealth highlights a few other major themes that are guaranteed to inject volatility into the back half of the year. We're entering the Kevin Warsh era at the Fed. We are facing new 10% Section 301 trade tariffs based on unfair labor practices. And of course, we have the historical volatility that always accompanies midterm elections. It's an incredibly complex, multi-layered macro environment. Section 2. Why growth only is a trap in 2026. All right, we need to bring this top-down institutional view down to the micro level. We need to talk about your money. If you're ignoring these headwinds and focusing purely on the AI doom, you are walking right into a trap. Here is the ultimate paradox of 2026. Goldman Sachs is predicting a 12% equity rally, what they're calling a broadening tectonic bull market. But right next to that incredible opportunity is the severe fragility of the banking system. When big banks feel the squeeze, market liquidity can literally dry up overnight.
So, to protect yourself, you need to understand where the growth is actually coming from right now. Commonwealth points out that while the full index is expected to see massive 24% earnings growth, the other 493 stocks, the non-Magnificent Seven, are finally catching up with 20% growth. This broadening out of the market gives you the absolute perfect foundation for what they call stealth diversification. Here is the kicker. If your portfolio is concentrated 100% in high-flying growth ETFs like SMH or VOO, you are effectively driving a race car with absolutely no brakes. When the next banking liquidity drain hits, those high-growth tech stocks drop the fastest. You absolutely do not want to be forced to sell your favorite assets at a 30% discount just because you need cash during a market panic. Which brings us to Section 3, building the multi-asset shield. So how do we actually capture the upside of that 12% rally while protecting against the invisible debt bomb? We do it by translating these Wall Street defense mechanics into an actionable strategy for Main Street. We build a multi-asset shield. You divide your capital into a 70-30 split. 70% of your portfolio is the engine, and 30% acts as your shield. This balance lets you stay fully invested in the AI boom while entirely insulating a portion of your wealth from sudden banking tremors. And this brilliantly illustrates how the two sides work together. Your 70% engine captures broad market momentum, think Vanguard's VOO or Invesco's SPMO. But that 30% shield, that's made up of low correlation assets. We're talking about short-term treasury ETFs like SHY and cash-heavy dividend aristocrats like KOW. When your tech stocks inevitably take a hit, these shield assets barely even flinch. Actually, pause for a second. Stop right there. We need to talk about Section 4, the hidden defensive winner, because this part is absolutely crucial. Look, having bonds and dividend stocks is great, sure, but there is one specific, complex financial instrument that massive institutions actually use to protect capital when the banking sector panics. Meet BTAL, the AGIQ U.S. Market Neutral Anti-Beta Fund. Most retail investors have never even heard of this ETF, but it is the exact tool that survived and actually went up during the last major banking scare when tech stocks were crashing. Let me break down how a market-neutral fund actually works, in plain English. It systematically bets against highly volatile, high-risk stocks, and it places bets for stable, low-risk stocks. Think of it like a giant financial airbag. When the market panics and money flies out of risky tech, it flows right into the strategy, instantly padding your portfolio against the crash. So here is your 2026 action plan. The goal here isn't just to play it safe, hide in cash, and miss out on all the gains Goldman Sachs and Commonwealth are forecasting. No way. The goal is resilience. By moving 30% of your capital to shield assets, like those short-term treasuries and dividend stalwarts, and blending in just 5% of a market-neutral fund like BTL, you ensure your wealth doesn't just evaporate during a banking shock while still riding the AI wave. I want you to seriously look at your own 401k or brokerage account today and ask yourself honestly, are you driving a race car with no brakes, totally exposed to hidden banking risks? Or is your wealth securely armored with a multi-asset shield? The data is crystal clear, the strategies are right there, and now it's entirely up to you to position your portfolio for whatever 2026 throws our way. Keep learning, keep protecting your wealth,